Welcome to Sachs Realty's Tuesday night podcast, where we talk about anything and everything real estate. Each week, we deliver expert information enabling you to make better informed decisions while keeping more money in your pocket. If you're interested in real estate, this is your show. Hey guys, welcome to our live. I am in Seattle, Washington here. And so with a little bit of a time difference, it's 5 o'clock here, 8 o'clock back at home. I'm really excited because as you know, we always try and bring you the current information on what's going on. And there's so much happening in banking right now. Mainstream media is covering the fact that banks are struggling. Seems like every other day we're hearing something in the news. So I thought that there would be no better place for me to come to than to Mr. Brent Beardall's office. He's the CEO of Washington Federal, and they're also in the news because they're buying another bank. And this is no small player in the banking industry, and a very solvent bank. And tonight, Brent and I, we've been talking for the last couple of hours about how his bank is doing. He's got a great story to tell too. I'm excited for you to meet him. Now, also, Mr. John Maxfield here. He is Maxfield on banks. So he has been studying the banking industry for 20 plus years. He lives in Portland. So we flew in a couple of days ago to Portland first, and then we did some podcasting. I'm excited to bring you these videos in the next coming days and weeks. But anyway, tonight, guys, Melissa, thanks so much for holding the fort down back home.
Yes, thank you so much. You are quite the traveling man, I will say, lately. Lots of fun. Looking forward to some awesome content coming on our show. But John and Brent, so grateful you are with us this evening. Really looking forward to hearing what you have to say about what you're seeing in the banking world. But please, everyone, bring in your comments and questions, and I'll be fielding them to John, Brent, and Todd this evening. But why don't we go right ahead? John Maxfield, go ahead and introduce yourself to our audience.
Yeah, sure, Melissa. It's a pleasure to be here with you and Todd. You know, as I told Todd yesterday when we were down in Portland, it's such an honor for not only Todd, but for him to bring a team out all the way across the country to talk to me and Brent. That we're just so appreciative that you all were willing to do that. So my name is John Maxfield. I'm a kind of a student of banking. I think that's probably the easiest way to define what I do, because I do a variety of different activities, but it's mainly all about studying banking and then spreading that knowledge as best as I can, and then spending time with people like Brent Beardall, who's as all of you know, he's the CEO of Washington Federal Bank, WaFed Bank now. They've rebranded themselves. But the thing that to know about WaFed Bank is that so there's about 4,600 banks in this country. There's about, give or take 500 of those that are publicly traded. If you rank every single publicly traded bank by all-time total shareholder return since their IPO, so that's the total amount of value they've created since going public, WaFed Bank ranks 7th among every single bank in this country. So when Brent Beardall speaks, this is not just some banker speaking. This is somebody who speaks with authority. And that's why we're here up in Seattle.
Thank you so much, John. Really appreciate all of that. Looking forward to a great show this evening. Brent Beardall, hello. And why don't you introduce yourself and tell everyone about what you're doing up there in Seattle.
Yeah, thank you, Todd, and thank you, Melissa. Grateful to be here with you. Brent Beardall, I have the good fortune of being the CEO and vice chairman of WaFed Bank. Today we're a $22 billion bank headquartered in Seattle. We have operations from Washington down to Texas, 8 Western states. We just announced last week that we got approval from the FDIC to acquire Luther Burbank Savings, which is an $8 billion bank in California.
We're covering what is going on with the banking crisis in the U.S. And as I said, firsthand, here we are we're in Seattle, Washington tonight, talking to Brent Beardall, who's the CEO of Washington Fed, or WaFed, as they've rebranded themselves. But what I want to do here, let me tell you guys how special this is, because Brent and I have spent the last, like I said, couple hours talking together, and I knew what I was, what I was going to hear today. And in fact, I came asking the question because a lot of people don't realize that Brent was in a very scary event about a year ago. Brent, I would just, one of the things that we were talking about was, so many people are sidelined today. Home buyers are sidelined. People are struggling to pay their bills. We want to think that it's the end of the world. And then we hear a story like what you tell, what you lived through. And it really, was such an inspiration talking with you about how, when I asked you, what should people be doing that are sidelined? What do we tell these young people that are having a hard time paying their bills? And we want to get so wrapped up in everything else that's going on in life. So if you don't mind, just take a minute and tell everybody, what you went through a year ago.
Sure. Happy to do it. And thank you, Todd. And first of all, I don't want to minimize what others are going through because it's real and it's significant. And I can't put myself in their shoes. But let me share a little bit with what's happened to me in the last just over a year. So on January 2nd, I had the good fortune. I was heading down to the Rose Bowl on a private airplane of a client of ours. And I was seated in the co-pilot seat, and we were just taking off from the airport in Provo, Utah. It was a very nice aircraft, seated about 12 people. And we took off. Everything's great. We're going about 200 miles an hour, about 200 feet off the ground. Then all of a sudden, things changed. And that's one of my learnings is how quickly things can change. Literally like flipping a light switch. Things can go from very, very good to very, very bad. And for whatever reason, and the NTSB is still doing their investigation, the plane barrel rolled hard left and down to the point that the tip of the aircraft started dragging on the ground, and then the nose went head first into the ground at about 200 miles an hour and just crushed the front of the airplane where I was seated. And then we rolled about 10 to 15 times, which was a blessing in hindsight because that severed the wings and the jet engines, which is where the wings are where the fuel's at. So everybody asked, you survived a jet airplane crash. How did you not burn? And that's what happened. But some amazing life lessons. My friend, the pilot, unfortunately passed on impact. And I had some life-threatening injuries, and to the point that it was questionable whether I was going to survive. And so I am truly grateful to be here. And one of the lessons of going through that is just never taking for granted tomorrow. Never taking for granted this next second, and being grateful that we're given tomorrow. So no matter how bad we think things are, and talking about banking crises, and I wouldn't say we're in a banking crisis at all now. There's some headlines, and last spring we did have a mini banking crisis, if you will. But even if the FDIC showed up at my doorstep saying, Brent, we're going to close down WaFd Bank because of XYZ, I would fight tooth and nail. I would tell them why they're wrong because I believe in what's happening. I know that foundationally how strong we are. But at the end of the day, so what? Take the bank. I'm alive. And they can't take that from me.
Yeah.
And having that perspective is something that I will forever be grateful for.
Yeah. Well, let's jump into the headlines that we're hearing about the banks being in trouble. I mean,
hey, Todd, can I say something before we move on to the different topic? And that is that everybody listening to this podcast will, if they haven't already, will experience some type of tragedy or hardship in their life. It is inescapable. There's no way to avoid it. And the question is when you experience something like that, what do you do with it? And a good friend of Brent and mine's, a guy by the name of Mick Blodnick, one of the greatest bankers in the history of the United States, has this great saying. He says, he says, hardship and adversity can break you, or it can cause you to break records. And that's the situation. One of the things, and you and I talked about this yesterday, Todd, one of the things that I've noticed, I've gone across this industry, I've talked to hundreds of bank CEOs, I've identified who I believe to be the best bank CEOs in this country. And at a certain point, I got to know them on a very personal level. You can ask Brent about that. I know these people on a very, very personal level. And at a certain point, I stepped back and I said, what is it? Because there's nothing in the data that showed what made truly extraordinary banks and what made truly extraordinary bankers. And at a certain point, I stepped back and I said, okay, just subjectively taking all the data in, both the analytical data and kind of the non-subjective data, like, or the more subjective data, like what is the commonality among these people? And the only thing I could find is that all of these people experience some sort of tragedy or hardship early in life. And there's a lot of reasons for why this is. But the point being, the message I want to send right now to everybody listening to this is that, like, you can turn tragedy and hardship into incredible success for yourself and for others. And that's how you should look at it. You should never be down. You should never look at it as a liability. It is your finest asset that you have. And so, yeah, I just want to make that point.
Yeah, good point. Definitely. Brent, we sort of established that with everything that's going on in the news, and we're talking about bank failures, and we saw some of the largest bank failures in the last 12 months. There's a lot going on we'll dive into with the Fed and the emergency funding program. We'll get into that a little bit. Interest rates, your opinion on where we think things are headed, because as we heard in a couple sources today, was that the Fed didn't say this, but I think there's more skepticism now that the interest rates are going to go up, which is bad for banks. We know that you're not happy about rising interest rates, but they're talking now that maybe we'll see a bump up before we see any kind of reduction in rates now. Again, the Fed hasn't said that, but there's some speculation that's floating around. But one of the things I want you to talk about, Brent, is the importance in running a bank is that there's almost two sets of rules going on right now. There's the too big to fail bank, and then there's everyone else. And I think what we're seeing now with the bank failures, and this has happened before, where they pick the winners, they pick the losers. And so just kind of explain, what is the state of the banking right now? What does it mean when there seem to be these, the difference between a bank like yours, which is not too big to fail, and a bank like, JP Morgan Chase or Jamie Dimon that, obviously would be bailed out, and
would be catastrophic to our economy if they were to fail. So they would be bailed out. Yeah. Thank you for asking that question. And that's one of the biggest failures in my mind of the regulatory agencies of last spring, is they really created a bifurcated banking system. Those where you have the perception, if you have your deposits with banks, and where is that line? I draw that line at $100 billion because that's what Signature was when they failed, and their depositors were made whole. So if you have your deposits at banks at 100 billion or greater, you have this implicit guarantee that the U.S. government will step in and it will make you whole. And if you have your deposits at banks under that, you need to be worried if you don't have FDIC insurance. And to me, that is wrong. That is un-American. It's not what was designed. If you talk to anyone, if you talk to Chair Powell, if you talk to Secretary Yellen, they will say, no, that is not our intention, but that's what has come of this. And even if you go back to the Great Recession, the whole intent of Dodd-Frank was to make sure we were never in a position again to have too big to fail. That's why these large banks have to implement these living wills. How are they going to wind them down? But when push comes to shove, when there's panic, when there is fear, and it's one of the things John taught me that I wholeheartedly agree with. As bankers, our primary currency is confidence. We have to have the confidence of the public. Once we as bankers, and banks specifically, lose that confidence, kitty bar the door and watch out. And that's exactly what happened at Silicon Valley. We can talk about the reasons what happened, but they breached that confidence of the public, and the public withdrew their money at record paces. And then the same thing happened at First Republic.
And John, we spoke about that yesterday where we were talking about confidence. I asked you the question about Powell testifying to Congress about the banking industry being resilient, and then we saw more banks fail. And I asked you whether it was oversight on their part, or whether, whether they were deliberately, whether Powell was deliberately saying, what he knew wasn't true. And can you just kind of talk about what would have happened with had he said what the state was, what was really going on?
Yeah. So banking there's a number of peculiar characteristics of banking that makes it different from these other industries. And one of them is that there is an interconnectedness of all the banks in kind of this industry, is kind of like one ecosystem. And the problem with banking is that all these entities, and to a certain extent, are black boxes from the perspective of these are just big balance sheets, and these balance sheets are based on valuations, and these valuations to a certain extent are subjective. So there has to be a lot of trust in the system for the system to work. And so, but you go through time, and you'll have like 10 years where everybody's trusting banks and everything's going real, but then you'll have these seams in history where things will break momentarily. And one of the things that breaks as a consequence of that is the trust in these institutions. And when you have that confidence break in these institutions, what you have is you'll have one institution that has problems, but then people will then start to second guess other institutions. And let me give you a specific example. We talked about this yesterday. In the 1920s, you had about 600 banks fail a year on average. That's less than the Great Depression, but 600 banks a year is a lot of banks that failed. And there was a study in Florida done in 1925 that looked back on most of the on a lot of, I think it looked at 1,100 bank failures that had occurred in Florida, Georgia, Alabama, kind of that southeastern region. They said, well, what were the causes of these failures? And then they put all of these into a pie chart. And they estimated that 55% of those failures, 600 failures a year for 3 years, was a cause of unsubstantiated rumors. The point being that these are incredibly fragile institutions, but the reason they're fragile is because we as a society value growth. And the way you achieve growth in an economy like ours, in large part, is through the extension of credit. And so when you think about banks and you think about what the purpose of banks are, really the purpose of a bank is to fuel the growth of this country. And if you can fuel the growth of this country, you fuel the power of this country. So anybody who's patriotic and goes around, saying negative things about banks, they do not understand, in my opinion, the connection between the prominence of our nation and the importance of our banks.
Do you think Powell, when he testified, knew that there were more bank failures that were headed that way?
I think Powell had a very good idea, but the issue is that when you're a guy like Powell or somebody who's in a position of kind of knowledge and authority and respect in the banking industry, you can't come out and say, because of the fragility in banking and because of the contagion factors, you can't come out and say that, like, yeah, we think other banks are going to fail, because that becomes a self-fulfilling prophecy. So you have to be really disciplined. Even somebody like me, who's kind of a clown, who, isn't really a major player, but who knows a little bit about banking, even somebody like me feels a duty to be responsible with the words that we say when we're interviewed in these times, because in those times when we're on the media a lot.
And if I could chime in on that, certainly these are challenging times for banking, but you have to look at it in relativity, right? Compare these times to the Great Recession, going into the Great Recession. And could we have some bank failures? Absolutely, we could. But the banking system is so much stronger today than it was in 2006, 2007. We learned some very valuable lessons. So I'm not Pollyannish just to think everything will be okay. Hey, we've got some problems and we'll work through those problems. But I think the message that I want everybody here to understand is the banking system is stronger today than ever before, in my opinion.
Yeah, and to put a finer point on that, like, under no circumstances are we in a crisis right now. Like, this is a very healthy industry right now. That doesn't mean that everybody's going to survive for an indefinite period of time, but we're in a very good position right now.
Well, let's talk about interest rates, because we know that's with rates being near 0% for many years. There were some valuable lessons that we've learned from that in the GFC. That's bad. Allowing prices to skyrocket, allowing debt to increase. We've never seen credit card debt as high.
It creates bubbles, right? Having rates near zero creates bubbles.
Right. So now how does that affect you, Brent? Because a lot of people, they ask the question, when people talk about how banks are hurt with higher Fed rates, the overnight rate, that's higher. People say, well, we listen to like Peter Schiff, for instance, says, how banks are in really bad shape because they have all these low mortgage loans, 30-year fixed rate loans. They've invested in these government bonds. prices, have gone up on bond prices and interest rates. And then we get the flip side of it. People will say, well, that shouldn't affect the bank because you're selling off those loans. Most banks, now you portfolio loans, but most banks, they sell them off. How are the banks that sell the loans, let's just talk about residential mortgages in this case, how are they still affected when they sold the loan? They no longer have it on their books.
Sure. So that's just the residential side. So you have to look at each balance sheet, specifically their circumstances. But if you sell the loan, the question is, what assets do you keep on your books? So while they may not be keeping the residential mortgage, in all likelihood, they have a significant concentration to commercial real estate, which is something I hope we dive into a little bit. Because as we talked about, one of my personal pet peeves is people say, oh, commercial real estate, that's dangerous. Stop the presses. What kind of commercial real estate? Commercial real estate covers such a wide, segment of the marketplace. There is a very different risk in commercial office, which I fully acknowledge the risk in commercial office. But even within office, it depends. Are you talking about Manhattan? Are you talking about St. Louis, Missouri, San Francisco, or Bellevue, Washington? Because the risk characteristics are very different. So you cannot paint such a wide brush. That's just office within commercial real estate. Commercial real estate also covers hotels. Hotels are doing phenomenal right now. It also covers multifamily apartment loans. And we can talk about apartment loans. It also covers owner-occupied commercial real estate. So it's such a broad segment. You have to understand, what is the balance sheet of the banks? What if they're not investing in single-family mortgages? What are they investing in? And you can understand what's the risk profile.
Should somebody ask their bank what I hear 70% of a bank's balance sheet is real estate. Is that an accurate assessment?
Depending on the bank, more or less. For us, it's about 85% of our loans are real estate based. And I say that's a phenomenal thing, because of our loans that are 85% of our loans are real estate based, we have on average about 40% equity. Think about that, 40% equity. So you would have to have a deterioration of value of 40% just to get to break even. So I would much rather a real estate loan where your borrower has significant amount of equity than a unsecured consumer credit card loan, for example, because you're going to have much higher. So you have to understand, dig deep beneath the headline.
So when you're talking about 40% equity, what percentage of that would be skin in the game and cash from the borrower? And what percentage of that would you, in that 40% scenario, would you say has been the property appreciation over time?
Yeah, so there's certainly some of both, but obviously loans amortize over time, so they continue to make principal and interest payments. So of that 40% equity, I'd say on average 30% is cash equity that people come in with, and 10% is net appreciation over the life. Those are just broad generalizations.
So when you're talking about how banks are affected in a negative way with rising interest rates, what would you say the main impact would be? When we're looking at and when I look at real estate loans, I can remember not that long ago, 6.5%, 7% was a pretty good rate. For a 30-year fixed rate mortgage. And on the commercial side, 8-9%, not too bad. That's where we are today, right? And in a lot of cases. So how is it that with the Fed, with their current rates, how does that impact you as a bank in a negative way?
So twofold. You have to look at both sides of the balance sheet. Let's start with the most important negative impact from my perspective, which is on the right-hand side of the balance sheet, the funding. How do you pay for the loans? And we pay for those with deposits, and we pay for that with borrowings. So you have pretty much a direct correlation to what the Fed is charging. And there's a lot of talk about deposit betas. So that's simply what percentage of what the Fed increases do you have to pay on your deposits? And historically, deposit betas on commercial banks are fairly low. You're talking in the 20 to 30% range. But what happened with the crisis is deposit betas went way up. So that is a squeeze on your margin because your funding cost had to go way up. So that's the primary impact on the right-hand side of the balance sheet. Then the left-hand side of the balance sheet, your point is well taken. If you have portfolio of those 30-year mortgages like we have, 30-year mortgages have negative convexity, meaning it's never worth more than the day you originated. If it stays on your books because rates have gone up, then you have a below market value loan. So the fair value went down. And if rates go down, in all likelihood, that's going to prepay and come back to you. So you have to, on the asset side of the balance sheet, is what happens to the fair value of the underlying collateral you have.
So from a bank perspective, and if you were originating these 30-year fixed rate mortgages below, or just say 4% or below, you're really hoping that they sell.
You're counting on the prepayments happening, right? If it's a 30-year mortgage, you look back over the last 30 years, on average, a 30-year mortgage will have about a 7-year duration.
Do you think that along the same line as that, we talked about inventory shortages? We know that, a large portion of these home mortgages are below, 4%. And some people are saying that that's preventing people from selling. You think that's a fair assessment?
Oh, unequivocally, yes. All right, there's people that are living together divorced because of their mortgage rate.
What would it take? Where would that mortgage rate need to be for these, sellers to start coming out of the woodwork?
I think each incremental step down, but what we've seen is mortgage rates got as high as about 8%. Then they came down and they were just in the mid sixes, right? It's not directly correlated to the Fed. The Fed controls the short end of the curve, and mortgage rates are based off of the longer end of the curve, which is the expectation of where the short-term rates will be over time. So that's a 10-year bond that they're tracking. So you saw the 10-year bond get up all the way to 5%. It was north of 5%. Then as recently as 2 weeks ago, the 10-year was all the way down to 3.8%. Today, it's around 4%. So you have 30-year mortgages. I think the headline today just went up about 7%. I think if you can get to within about 150 basis points of where people have their mortgage loans, at that point, they'll start to move.
So 5.5%?
5.5% for 3.5%.
Yeah.
4% mortgages. Yeah.
We talk about, John, why a lot of these banks have failed, and actually before Brent, let me just follow up with what we were talking with Silicon Valley Bank and bank runs, and which will lead me and John to talk about the bank failures and the history of bank failures. Brent, I think it was about 2021. You can correct me if I'm wrong. The Federal Reserve eliminated the need for banks to have a reserve, a bank vault type of reserve to safeguard against bank runs. I think that was one of maybe it was 10%. I'm not sure, because it was designed. We know that from history, to where one of the ways to safeguard the bank, and one of the Fed's roles, was to make sure that banks kept a reserve, so that if we had an event like Silicon Valley where, headlines and some hysteria breaks out and people line up at the bank to get their money, that they would be able to, pay a percentage of their depositors. What's going on with that? What's the state of that? Should banks be able to take and invest 100% of the depositors' money? Should they be required to keep a vault reserve?
Sure, there's no questions, and the rules ebbs and flow. But as long as I've been in banking, there are always liquidity requirements. There are always stress tests. You should look and say how much can we withstand in terms of deposit losses and fund those. That's a fiduciary responsibility we all have as banks. The question is, how much can you withstand in a fractional banking system? So even the strongest banks in the country, if JP Morgan Chase, which I believe is one of the best banks, one of the strongest banks in the country, if they saw a run similar to what Silicon Valley saw, they would be in trouble. So let me put it in perspective. The largest failure in U.S. banking history was Washington Mutual, which failed in September of 2008. Washington Mutual lost 11% of their deposits over 9 days. So 11% in 9 days. And the FDIC said, that's too much. We're going to step in. They seized WAMU and sold it to JP Morgan. So that was 15 years ago. Fast forward 15 years, March of 2023, Silicon Valley happens. And we're talking about what caused Silicon Valley is a whole podcast by itself. But they blew it and caused a run on the bank. They lost 26% of their deposits in a single day. Think about the magnitudes. Think about how quickly it went. WAMU lost 11% of deposits in 9 days. Silicon Valley lost 26% in a single day. There is not a bank in this country that is built to withstand losing a quarter of their deposits in a single day. So you have to keep that confidence in the system. And so I don't view it as a failure of regulation in terms of liquidity. I view it as a failure of regulation to keep them from doing the stupid things that caused the run.
John, you say that banks do the same stupid thing that caused the run again and again and again. And in fact, you say one of the things that you're doing is in talking with bankers is trying to, not everyone is as solvent as Brent here. They make some bad decisions. We talked about that. I mean, one of the worst things a bank has is cash, right? I mean, they get they get the liquidity from depositors, and then the pressure is on the CEO to deploy this money, not just let it sit in the bank. So they make bad decisions on, loosening, their borrower profile as far as their credit worthiness. So what do you have to say here? Not that there's you have a different opinion on the failures, and you say that more failures are coming. So how do you come up with that analysis?
So a couple points. The first is that stupid isn't the adjective that I would use, and the reason I wouldn't use that adjective, and I know you didn't mean it for that purpose, but it's important to kind of clarify the situation. So, people run banks, humans runs banks, okay, and there aren't a lot of perfect human beings in this world. At least I haven't met any. I'm certainly very far from that. Brent's a lot closer to that than I am. You're probably a lot closer than I am to that too, Todd. But you have policemen who are really good, who are really bad, who are in the middle. You're right. You have plumbers who are really bad, who are really good, who are in the middle. It's the same thing with banks. And so, like, when you look at bank failures, the bank failures are not necessarily a product of stupidity. The bank failures it's much better to think about them as a product of the system that we have built, the system that society has decided upon for what our values are in this society. And one of our greatest values in America is economic growth, right? And so there's a cost to economic growth. And part of the cost to economic growth is that when you use a credit-fueled system to achieve that, which is the only one we know that really works, unless you're using an export-driven model, which just isn't viable to a country like ours. When you use that type of system, you are subject to fragility. So people can sit and criticize bankers all day long, and that's fine. But the reason we have our standard of living in this country is because we have this economic model that's driven and fueled by credit. And it's the bankers that are out on the front lines doing that are kind of achieving that for us. And so it's really easy. And there's a lot of historical reasons why there's this kind of general animosity towards banks in the country. But when you dig into, if you're serious about it and you actually care about the truth, as opposed to just saying things that are in headlines, and you dig into the reality of the situation in the past, what you find is that some of the greatest bankers in the history, many of which have been painted with a negative light, are some of the greatest people in this country's history that have done more for this country than anybody else. And so it's just something to keep in mind, that like to say that bankers or banks are bad is the same thing to say that plumbers are bad. That's absurd. There are bad plumbers, there are bad policemen, there are bad bankers. But to paint the whole industry in sort of a negative light is just it's a detachment of reality, and it's something that we should all be pushing ourselves harder to try to get to the bottom of these issues before we form conclusions.
Well, but along the lines of that, you have Silicon Valley Bank.
Certainly.
I mean, so that costs a lot of money. Who's paying for that?
Costs a lot of money. And who's paying for Silicon Valley Bank? Who's paying for Silicon Valley? You are. I'll tell you,
let me be clear, because that's important. The banks, right? It's not the taxpayers. The banks paid for the failures. The FDIC fund is funded by the banks.
They have that much money in the FDIC?
Not only do they have it, if they don't, they have special assessments, which is just what happened. In fact, Jamie Dimon just had a very controversial proposal. It will never happen. But he said, hey, the FDIC is really a cooperative. You should let us as banks run the FDIC, and we'll police ourselves, which would be an interesting experiment. It will never happen.
Well, let's just talk about Jamie Dimon for I mean, I have a lot of respect for him too. I don't know him like you do, but certainly, anyone that has built an empire or can maintain an empire. I mean, look, you can build. There are a lot of people that inherit businesses, and inheriting a business does not mean that will be inheriting the success prior to you taking over that business, right? I've seen plenty of people that have inherited a lot of wealthy businesses that were succeeding, and they drive them straight into the ground. So, I mean, when you have somebody that's at the helm of JP Morgan Chase, I mean, you have to respect the fact that, he does a really good job at what he does, right? But let's talk about the creation of the Fed for a minute, the Federal Reserve, 1913, the book Jekyll Island, and that trip that these 6 businessmen, I think 4 of them were either working for or representing JP Morgan, right, that wrote the Federal Reserve. Is there any correlation to, I mean, when we look at a bank like, JP Morgan Chase, and then we look at the Federal Reserve creation that was said to be written in 1910, or that secret trip, that duck hunting trip that wasn't a duck hunting trip.
Yeah. Well, so is there any correlation? That one could be debated. Let me just say this. I have the utmost respect for Jamie Dimon because he is an operator. His attention to the detail, his knowledge of the details is phenomenal. And if there's anyone who's benefited from the banking crises of the last 15 years, it's Jamie Dimon and JP Morgan Chase. Right? And his story is phenomenal. He got fired from Citigroup. Before he went to Bank One at the time, which then got acquired by JP Morgan Chase. And who was there to answer the call when the FDIC needed somebody to take over WAMU? Jamie Dimon was there. Who was there to answer the call when they needed somebody to take over Bear Stearns? Jamie Dimon. Who was there here recently last spring for First Republic? Right there are the 3 largest failures in U.S. banking history. And Jamie Dimon was there to answer. And certainly there was risk taken, but the benefit was remarkable. And that's what's generated what they have today. But from my perspective, we should not have too big to fail. And if I were in charge, there's this thing called the 10% deposit cap. And one of the rules is they should not allow banks to do acquisitions once you have more than 10% of the deposits in the United States. Concentration is a bad thing. And they look the other way to allow some of these failed banks to go to these too big to fail banks. And I personally think we should enforce a hard cap and say whether it's by acquisition or organic growth, it is not in the best interest of the country for any one institution to have more than 10% of the deposits.
That might apply to real estate investors. I could argue that, right? From you start to get these REITs and these different funds that are buying up all the available real estate in America, and so that's a good point. Melissa, do we have any questions?
Oh yeah,
All right,
we definitely do. I'm going to start with the super chats first. We're going to just start it off with this one. Total BS. You're failing because you actually don't have the money. If you're utilizing fractional reserve banking, you are systemically risky. These guys have fancy suits and expect us to be ignorant. Did they predict 2008?
Let me answer that.
Please.
Can they see me on camera?
Of course.
Yes.
Okay. I want to you know that I'm wearing Costco pants. I'm wearing Puma socks that I got from Costco. I'm wearing these shoes that my brother-in-law bought me. I'm wearing a jacket that I bought at Nordstrom's only because my videographer is so embarrassed by the clothes I wear. And I'm wearing undershirts that are so old that even my mom is embarrassed by them. Okay. I don't like to talk about myself, but I'm going to say this because Brent doesn't have to say this. I'm one of the preeminent banking experts in this country, and these are the clothes that I wear. Okay. I don't go around promoting these guys because I get paid a bunch of money to promote these guys. I go around promoting these guys because these are some of the best people I've met in the entire world. These are incredibly good people. It is a mistake to paint anybody with a broad brush. Like if you're a banker, you're a bad person. You're a policeman, you're a bad person. You're black, you're a bad person. You're white, you're a bad person. You're Jew, you're a bad person. These are ridiculous ways to think about things that we should be beyond at this point in our lives.
Did you predict 2008?
Yeah, Brent and I both did. That's why we're so rich.
It's really easy in hindsight to say, oh, of course we did. But the fact of the matter is we saw some of what was happening and we didn't do it. We were called a dinosaur in 2006 because so many of the mortgages being made were the pay option arm. Everybody was doing the pay option arm. And people said, WaFd, why are you not doing the pay option arm? And we said, simple. It's ridiculous. You are taking interest rate risk and you are putting it on the person that is least capable of sustaining that risk if something bad happens. And as a result, you're just you're compounding the credit risk. And it proved to be accurate. We didn't have a single pay option arm. And that's one of the reasons we were able to survive.
And I think it's fair to say that the FHA is following somewhat along those same lines of why they're experiencing almost 10% delinquency right now. And so to your point, and look, we're in the same bucket. I mean, we're probably in a worse bucket because realtors, it's easy to say that we have failed miserably. The industry. I mean, we're supposed to be fiduciaries, and there's quite good reason why the public has the opinion, but not everybody can fall into the same bucket. I mean, I think, and to your point, I mean, you're running a great shop,
But that being said, and I appreciate that, and we do feel like we're a good bank, but we're far from perfect. We make mistakes every single day, and I think that is one of the keys to learn from others' failures. And we've talked about the hubris that leads to bank failures, and part of that hubris is to not be realistic and say where are we falling short. And that's one of the things we really try to encourage here at WaFd Bank is to call out where are we falling short, what can we learn, and oh, by the way, we have a strong opinion that this is going to happen with rates. What happens if we're wrong, right? That's exactly the question that Silicon Valley should have answered. What happens if they were wrong when they invested the $90 billion in mortgage-backed securities? So never be so confident in your opinion that if you're wrong, you can't survive.
Yeah.
That's a really good lesson.
Melissa?
We have another super chat as well. So if banks are stable and healthy, then the Fed interest rates shouldn't be brought down. Actually, I think there should be deflation.
Yeah, I don't think the bank or the Fed, moves interest rates based on banks' health, right? The Fed, their mandate is clear that they want full employment and low inflation. And so obviously they're doing really, really well from my perspective on an employment front, 40-year lows in unemployment, and inflation has been out of control, and that's why they've had to move. Now inflation is certainly moving in the right direction, and that would be the argument to make for the Fed decreasing their interest rates is inflation is coming under control, and we all know there's a tail to their moves. So we're still going to have continued contraction. At what point do they want to start bringing rates in? But I don't think the Fed moves interest rates based on banks' health.
And let me make one other point. Deflation is one of those things that sounds really cool in theory, but when you study periods of time when there's actually been true deflation, it's an absolute economic catastrophe. In the 1920s are an example. I talked about this earlier. We had 600 bank failures a year. The reason we had 600 bank failures, and we had an absolute agricultural depression throughout the entire United States. The reason we had that, I mean, there were people literally with kids without shoes. There were people who didn't have food to give their family, because what would happen is we come out of World War I, where the commodity prices are super duper high because we're basically feeding all the troops in Europe. World War I ends, we still try to go back on the gold standard, which requires us to deflate our currency back to get it back into parity with gold. It was a decade of absolute misery for a good chunk of this country. So it's one of those things where it's cool to talk about in theory, but unless you've actually studied those periods of time when you talk about when there actually has been true deflation, I think you want to be more humble about your opinions about that type of thing. Because it's not as good as it seems in reality.
John, along the same lines of that, let's talk about housing prices because people are really struggling. We're talking about we're getting up to over 50% debt to income ratio for their mortgage payment, rents. Without some type, we're talking about 30-year-olds. They had roommates in college. They don't want to have a roommate at 30 years old. They want to be able to have a one-bedroom apartment, right? So when we're looking at, there's two things that could happen here. Mortgage interest rates, unless we would see, and Brent, you can speak more to this, but unless we see more quantitative easing from a federal level where they start buying mortgage-backed securities, I hope we don't see 3% mortgage rates again, because that was single-handedly probably the biggest catalyst of allowing these asset prices to get to where they were in the first place. And it sets these unrealistic expectations because now people are overpaying for the asset. We were in it. We lived it. $50,000 overpriced value, cash, mom and dad's cash to get into the house. No inspections, zero home inspections. I'm sorry. You want to ask for a home? What? Sellers aren't fixing anything. We got 25 offers. The house was listed at 500,000 and it sold for 6.25, or, relatively speaking. So in our world, and this kind of applies to both of you, because with real estate, one of the worst things the bankers want to see is that their asset that they financed drops in value. That's bad. But what do you tell the people? What's going to happen here if we're looking at a home that's trading at 8 times earnings, median? And by the way, the National Association of Realtors produced a chart, the HAI chart, Housing Affordability Index, and the 100 is the baseline. For anything north of the 100 means that an income earner, or a median household income, can afford anything north of 100, can afford the median home price, right? In 2006, at the height of the last bubble, it never dropped below 100. For the first time in 25 years that they've been tracking this, it's under 100 in the 90s, meaning that the average median household income can no longer afford the median home price, what's going to happen? I mean, what do you suggest? I mean, do you suggest home prices come down, or do you suggest that employers who are already tapped out, they're being affected by the high interest rates, their cost of doing business is going through the roof?
So let me jump on this one, John, then you can go. One of the things I am most surprised with is as interest rates went up on mortgage loans, we did not see the value of homes go down. Historically, it's what you see. Typically, for every 1% increase in the 30-year mortgage rate, you would see about a 10% decline in value. So mortgage rates have gone up about 300 basis points, 3%. So typically, to have affordability maintain the same level, you would have seen values go down by about 30%. That has not happened.
But Brent, they're lagging indicators. I mean, and just for argument of sake, let's think about this. Home sales dropped by 30% nationwide. The other thing that happened was builders were offering, with the only ones with the inventory, have been offering 5.5% mortgage rates.
Yeah, they're buying
for
down mortgage rates
months, and it hasn't worked. Their houses are sitting, their communities, they don't have sales. Their sales are very limited in the amount of inventory that they have. And this is shadow inventory. What they're reporting on the multiple list is not the true story, right? They'll put 6 houses on the multiple list, but they got 60 ready for quick close. So they're not reporting all this data. So I look at what's happened in, at least regionally, and I have brokers all over the country that I converse with all the time on what's happening in the market. We run the reports and things like that. We have seen prices drop in home prices. The hard part is, how do you compare a house to a house, an exact house to an exact house? Because here's what happened. From 2020 and the pandemic till about June of 2022, we had 0 concessions. So what's not being accurately reported are the seller contributions, the concessions that we're seeing now that actually go on in a new home construction, go on the mortgage side, this $50,000 price reduction because they're buying rate down. That has certainly impacted that home value. But what the builders can't do is they can't just drop their prices, because that upsets everybody that just bought in the community that's been under contract. But we're not seeing overappraised value, addendums anymore, which is in a way some type of a price reduction. We're not seeing the offers like we did back in the day. But I think that, and we're not seeing the foreclosures either, because of the moratoriums and because of the bailouts and all the things that the federal government has been doing to keep people in their mortgages.
But let me offer a little bit different perspective. What you're saying is true about the home builders, and they are being very aggressive to buy down rates to keep the sales going. And there might be a lagging indicator. Totally true. But there is just a lack of inventory in the market. You're not getting private parties going in and saying, hey, I'll buy down your rate for you. Not very aggressively. At least that's my experience. Maybe yours is different. And it's a supply and demand issue. And what not very many people talk about, one of the lasting impacts of the Great Recession is so many developers left the marketplace, right? People got absolutely burned doing land acquisition and development, and they left the marketplace. And then trying to come back in, all we have is more and more regulation. The period to develop lots is a lot longer and a lot more expensive. So we have this long-term supply-demand imbalance that is not getting a lot of press, that I think is foundational as to why prices haven't come back down, because there's so limited supply out there, at least in the markets we're in. That's what we're experiencing.
What do you think about and to your point? Oh my gosh! I mean, I was a builder. The regulation, the red tape. It is a finite amount of inventory. It's not. They're just not opening it up like they did post World War II, where they said, let's encourage these developers to go out and incentivize them to build these, cut the red tape and let them build these 1,600, 1,400 square foot houses. And that's why the builders are building these big boxes, because they can't make any money. By the time they develop the land, they put the infrastructure in, you fund it, you see all the soft costs that go into it, just from an engineering and architectural, and just to get the thing to.
And that's not even talking about all the fees that are being imposed left, right, and sideways.
Yeah. Impact fees,
Yes.
Reforestation fees. What do you think, though? So I think we finished out the year just under about 4 million home sales. And, I mean, historically, we're somewhere in the 6.5 million is where we like to see as a healthy market. And you're right, the inventory has been terrible. What do you think about what's your opinion on the baby boomers? And I mean, certainly markets like certain Florida markets will probably, that were a lot of retirees flock to when they want to downsize. What do you think about it? And there was an article, well, it was floating around there. I think Wall Street Journal picked it up, Yahoo Finance picked it up, but they said we could see a tsunami, a silver tsunami. They projected it to be somewhere around 30 million baby boomers could be downsizing in the next couple of years. So when we look at just figure a 6 million home sale normal market, what do you think? Do you think that we could see this silver tsunami? And what would adding 30 million houses do to the inventory issue?
Yeah. So let me say, I would view that as very unlikely. Could we see it? Absolutely, we could. I think it's incredibly unlikely. One of the things that I think we need to discuss is the whole concept of housing as an investable asset class for both institutional real estate, the Blackstones of the world, and also for high net worth individuals. Nobody's talking about this huge surge in wealth of the people that had wealth going in and what happened to their wealth going through the pandemic. People are buying multiple houses, and that's taking them off. And people aren't saying, "Oh my goodness, I'm going to liquidate my house because I think I can get a better investment." People feel very good about real estate. Because it's been a long time. It's been 15 years since people got burned. And we typically have pretty short memory spans. People think, hey, if we have real estate, you hold on to that real estate because the transaction cost you so much, you realize the taxes. If you hold it long term, and especially because you can turn around and rent it out, let alone the advent of Airbnb and all of these short-term rentals, you can turn it into a very cash flow positive. So the market has changed dramatically in terms of your perspective. It used to be in 2009, if the bank took back an asset class, our only hope to sell it, or a foreclosed house, our only hope to sell it is to find somebody who's going to move into it. Today, if a house goes on the market, you're competing against people that want to upsize their house in the neighborhood, people that are relocating to the neighborhood, and you're competing against institutional real estate that says, hey, this is an asset class we want to invest in.
Well, let's talk about that for a minute.
Let me make one more point about that you brought up earlier about housing affordability. So it's easy to look at. So the housing affordability is a ratio, right? It's a ratio of income to another thing. And the question is, what's the other thing, right? Is the other thing the value of the house, or is the other thing the cost of your monthly payment? Well, in the United States, it's not the value of the house, right? Because you're not buying the house. The person who buys a house is just paying a monthly payment. So the other variable you want in that denominator, in that ratio, is not the house value. That will create such a. If you're comparing that to incomes, it's creating something that doesn't mean anything, right? In the United States, where everybody gets most people get a 30-year fixed rate mortgage, what you got to do is you got to compare it to your monthly cost. And here's the thing to keep in mind. Right now, we're so stuck in this like rising rate environment. Oh, things are so horrible because rates are rising. But you can ask Brent, because Brent knows, because this bank, one of the reasons this bank has been so successful is because how they performed through the 90s with the interest rates. The average 30-year fixed rate mortgage rate in this country is what? It's 8.5% over long term. So like, yeah, we could sit around and complain today about like rising rates, but like it's still cheap money compared to what we're used to. As you know, you've borrowed a lot.
And I hear you, John, but here's the issue that really that we see in our world. Okay. And Brent can appreciate this because he deals on the commercial side, even though residential, but commercial. If an investor buys a non-occupied owner-occupied house, that's a commercial loan. Should be, right? There's differences, to the rule there. I mean, and you have Freddie Mac that gives up to 10. They've got an investor loan program where you can get a 30-year fixed rate on up to 40 doors if you can find 10 fourplexes. But here's what happens. We start out with the debt to income ratio and they get pre-qualified for the loan. but the house is a depreciating asset. So what happens is it falls down around the people, and I see it all the time, right? So it's not that they can't stop paying. So what happens is a lot of these people that have bought, and we're seeing it. We're seeing people that bought in 21 already are selling their house. I mean, I have one that's coming on the market. Young couple with a baby. They have to sell their house. We're seeing some of them come to the table with money because they're underwater. I mean, but you need 10% equity to sell your house by the time you figure about transfer, depending on what state you're in, transfer recordation fees. But the issue is that for many of these people, the roof's going bad. The HVAC's gone bad. With the inflation rate, you're not spending $10,000 to replace your HVAC anymore. It's $25,000 or $30,000. So I think that's where my concern is that when you start to see a stress in the neighborhood where you have, an asset class, a single family house where people over the last 2 or 3 years, 40% of the mortgages that are being created, or the people that have refinanced these, that they had equity and they sucked the equity out to buy their second houses. There's Airbnbs wanting to get a part of that, revelation. That's where my concerns are. I see it as with the debt being 1.2, almost over $1 trillion in credit card debt alone. How are these people how are they going to come out? Are we going to see massive wage growth? I mean, Brent, that's a good question for you on the commercial side, because you're seeing the cost of borrowing going up for the businesses that are the largest employers in America, these small businesses. Do you see where in the next couple of years that we will run through an economic, a good enough time in the next several years to where we could see wage growth catch up?
Wage growth catch up to the cost of housing. I think you're going to be hard pressed, from my honest assessment. But one of the things I found in being in this job for, I've been here for 22 years now, is expect the unexpected. Right? We look at things in the paradigm that we're used to looking at them. And you and I had this discussion in March of 2020. Everybody was scared to death about hotel loans, right? It wasn't office loans we were talking about. It was hotel loans. What's your hotel loan exposure? Because the pandemic, nobody's staying at hotels. These things are going to be worthless and it's going to flood the market. And guess what happened? Coming out of COVID, hotels are absolutely booming because people care about experiences and they want to get out there. And the hotel's profit margins are through the roof because they're charging more and they're doing less in terms of services, right? So we're all expecting hotel loans to go bad, and it changed. And so I think we're going to see small businesses figure out ways to be more profitable. And it's going to be doing more with less. And I think AI, which is the buzzword of everybody, go to McDonald's. McDonald's is now asking you to do the order yourself, right? I mean, they're doing more with less, and I think that's going to be pervasive through everything we experience.
How will that affect the affordability of? I mean, that should we be expecting one of the? I mean, I'm just asking a question. I mean, should we be expectant that one of our income earners will lose their job to AI coming here?
I personally don't think so. I think it's just the opposite. I think AI will allow us to, the jobs that it's really hard to get people to do. I think AI will take the place of that outside of manual labor, but it's the data entry. It's the things that are redundant, but it will allow us to upscale the jobs. And so people will be earning more.
So you think that it will increase the efficiency, essentially?
Correct.
Somebody can do more work because they'll be utilizing the AI technology.
You'll have the Microsoft Copilot, and it makes you more efficient, more effective.
Yeah. That's a good point. Melissa?
Yep, I'm ready. So we've got a question here. Todd, please ask them to comment about the recent Senior Loan Officer Opinion Survey report responses from top lender execs stating trend is to tighten lending requirements. In other words, how are they, or are they?
Yeah. Well, Emily, appreciate your question. You just asked them by saving me from needing to do it. Melissa, thank you for that. Emily is one of our agents in our network. She's been in the business for a while. She served on boards in the real estate industry and very knowledgeable. So Who wants to answer that, Brent?
Sure, I'll chime in. Absolutely, banks are tightening underwriting, and the bigger question is why, and that's because of capacity issues on bank balance sheets, primarily because repayments have slowed down so much. There's not a lot of people that have a 3.5% mortgage that are saying, "Hey, I want to refinance." Right? You have repayments at lifetime lows that I've seen. You've got a CPR rate of 4 and 5% CPR rate, right? The historic lows. So with repayments slowing down, you need to slow down the originations that are happening for what stays on your balance sheet. And one of the ways to do that is to tighten your lending standards.
Very good, Emily. Hopefully that was what you're looking for.
We got some more questions here. So let's take this one. Question: who pays the property taxes on these vacant, non-selling, new built homes?
Well, there's someone that owns it, right? Whoever the sponsor is that is built the homes that are non-selling. So whoever that sponsor is paying the taxes on that. And if they don't pay the taxes, then the lender will have the opportunity to step in and pay the taxes and take over ownership of it. So whoever the owner is has to pay the taxes in one way, shape, or form.
Yeah, and a lot of times they'll be on some type of takedown schedule. So depending on who the builder is and who the developer is of that land, they would be responsible for making sure that these lots are kept current.
This question comes up often, even as calls come into the office. When do you think is going to be the right time to buy? I'm almost certain this government is doing everything in its power to disturb the natural process of failure and just pretending that everything is okay when clearly it is not.
Well, I've been around long enough to know that I'm not smart enough to time the market. So the answer is individual to each person, family, or couple. The right time to buy is when you find a house that you need to be in for whatever your family needs and you can afford it. That's the right time to buy. And as a lot of people are saying, date the rate, marry the house. And there's a lot of truth to that because cycles happen. Rates will go up as they have, and rates will go back down. And we may be surprised, Todd. You may be absolutely right. Maybe the next Fed moves are increasing. I mean, you have to again allow that you could be wrong, but get into a mortgage that your payment is fixed, so you know what it's going to be, and that optionality you have if rates go down, you can refinance down.
Yeah. I always say, to your point, you have to be satisfied with the payment that you have now. It's, if you can refinance at a later time, that's all the good, right? If you or in a 6.5 and you can refinance at 5 and we'll stay there long enough to realize the profits of doing that, then absolutely. But certainly you need to be able to afford what you have now. And what I always tell people is, and this is a big concern that I have for a lot of young people because they move around so much. In college, they move every year, whether they're staying in the dorm on their first year and then moving to an apartment, and then they want to get a house in their junior year, or they don't like their roommate and they want to relocate. And so we're finding that spill over into their behaviors when they're buying a house. They don't realize like, oh, wow, I just bought a major investment here. And then some of them just want to turn around and sell it in a year or 2 years. And that's not how it works. So I always say, if you look at real estate values in the long run, obviously they increase in value. The chart speaks to that, with the exception of periods of time where we could see some deflationary times in housing prices. And what happens is a lot of times the price is predicated on the seller's motivations. Because for instance, if the buyer demand backs off, you never know when a seller just wants to get out of something and will drop a price to encourage a quick sale. These start setting pricing trends and comparable prices in the marketplace. So things can change rapidly. They can, regardless of, it can happen no matter what time we're in. But I think the important thing is, if you're not planning on staying in the house for 7 years, you may want to consider buying out because we're looking at prices that are the highest that we've ever seen.
Todd, let me make a point about kind of what the another point that the commenter made. And so it's easy to like get stuck in your time period and think like things have never been as bad as they are right now. That's like a natural human state. You know, they call it the end of the what do they call it? The end of the universe bias, I think is what they call it. And then when somebody says that, you say like, all right, well, like clearly they're bad now, but bad relative to what? Bad relative to China? Bad relative to Europe? Bad relative to history? Bad relative to what? Bad relative just are like we're just making up in our head. So let's go through history. Let's just go through history right now. We're just going to go through the United States history, and we're going to figure out if we're in a bad place or not. Revolutions to Civil War. Yeah, it's a pretty treacherous time. Okay, we just take that off the table because that was not a better place. The Civil War ends in 1865. A long depression in 1870. We have a panic in 1884. We have long depressions in the 1890s. We have the panic in 1904. We have panic in 1907. We have incredible depression throughout the 1920s. Then we have the true Great Depression in the 1930s. And then we have World War II. And we have World War I right before the 1920s, okay, where we're sending hundreds of thousands of soldiers to die, right, in foreign land. Then we come out of World War II. We have a low period where not really anything is going on. Then we have the Korean War, the Vietnam War. We have inflation, the incredible inflation because of the energy crisis, right? Then we have the tech boom and the tech bust, right? Then we have the financial crisis, which is the worst crisis since the Great Depression. And here we are now, like housing values are higher than they've ever been. Stocks are higher than they've ever been. Like in all due respect, I do not factually understand how anybody could think that we are clearly in a bad place right now. If you just look at history, if you look at our standard of living relative to anybody else's standard of living, we have the highest standard of living now than we've ever had before. Like we in this country are so fortunate to be here. You know what I mean? Like there's no reason to be so pessimistic about things.
Well, I think everything is relative in time, right? So certainly, if you want to compare it back to then, but I think what I look at as people are financing their necessities of life. I mean, we watched the automotive industry go through a period of time that, I mean, they're paying $1,000 a month for a car because they have to get to work, so I think it's all relative. I hear what you're saying. I mean, my gosh, I mean,
relative to like last year, relative to what? I mean, what I'm saying is that it's not bad relative to anything.
Well, I think everybody's situation,
relative to everything.
I think everybody's situation is, look, we know that debt. And I've been in a position where, I went through some hard times. I mean, I can remember back in the early 90s having builders beat me out of money as a contractor. I mean, it was bad, man. I mean, trucks being repossessed. I mean, look, tough times. So I think it's relative to your time. But I know that some of the it is relative, but relative to having, surviving a plane crash. Look, there's nothing. I mean, look, you live in a tent to be able to say, hey, I'm alive and I'm healthy and I have my, my kids in the tent with me with my spouse. I mean, you're right. I mean, I get that. But I think what happens is we're not doing a good enough job teaching financial literacy and the history of things, right? And at the same point in time, we're not acknowledging the fact that stress from debt is the number one reason for divorce. It's the number one reason for stress-related illnesses and disease. It's the number one reason to keep you up at night when you can't pay your bills. And especially when you're facing foreclosure, the worst thing in the world is having all your stuff tossed out in the middle of the street or being evicted. So I think, but you're right. I mean, it is relative. I think we do, John, need to keep that into perspective.
So if I could add one thing, Todd, I think maybe the question is, at what point am I buying, right? If you look back to the great financial crisis, certainly people that bought their houses in 2006, 2007 would have really liked to have known what was happening. They could have a better opportunity. But that's a great example, right? Even if they bought in 2007 and their values went down, depending on where they were, from 20% to 70% if you were Bend, Oregon, if you had a fixed payment, you knew what it was, you could afford it, you maintained your job, You held that through now, you're now double or triple the value of what it was. So it is relative.
Yeah. And if you can stay put,
Yes.
if you can decide to stay put and ride it out, right?
That ability to be resilient.
Yeah. Good point. All right.
Are you guys seeing layoffs in your industry?
There's no doubt about it. I think Citi Group just announced a 10% reduction in their industry. One of the things that we really try to do at WAFED is we try to be contrarian. So if everybody's doing one thing, we say, you know what, let's do something else. For example, in March of 2020, when Silicon Valley was buying all of those mortgage-backed securities, we looked at it and we said, this is insane. The cost of long-term money is so cheap. We went out, we borrowed $1 billion for 10 years at 0.65%. And we had nothing to do with it, Todd. We just had to park it, right? Everybody was awash in cash. And the board's like, what are you doing? You don't need it. I said, I don't know what we're going to do with it on the short term. On the long term, I know borrowing money for 10 years at a fixed interest rate of 0.65% is a home run. And that is one of the primary reasons that WAFED has done so well on our accumulated other comprehensive income, is because that hedge on that borrowing, it's been fantastic. So sometimes you always say, what is the herd doing? And we're trying to do different. And to your point, in terms of what are banks doing, most banks are cutting off because you're not originating loans. It's a huge reduction in loan origination. So most banks are cutting their staff of loan originators. And we take just the opposite approach. We say, you know what? We have an unwritten contract that you bust your tail, you do your job for us. We want to make sure that there's a spot. What do we need now? We need deposits. So we want people that used to be just loan originators to become true bankers and to sell all of our treasury management service to help us grow our deposits. And so we try to look at it a little bit differently, but there's no question in the industry there's a reduction in bankers.
Well, and that's why you're doing so well, right? And to my point, when I was saying to John, the mistakes, and I said stupid mistakes, stupid people make or whatever making mistakes, right? I mean, obviously you can take that.
Most other people
you can take that however you wish, but I mean, it's the money does you no good if you can't deploy it into a profitable, a long sustainable, investment. And that's what I think you just said is you took this money that you could get it, but you could have easily dumped that into a risky portfolio, or lowered your lending standards and things like that. And I think that's,
but I think something really important is, what time horizon do you have? Right? Because on the short-term time horizon, what we did was stupid, right? Why you're borrowing money? We literally borrow the money. We're paying 65 basis points. We could only earn 25 basis. So we are losing money. It's okay to lose money over the short term if you have a longer term horizon. Your point on, well, should you buy or not? How long are you going to stay there? What is your horizon? So it's, you have to answer the question of what is your horizon. And too many banks in today's day and age are too focused on the short-term results of Wall Street. What are you going to do next quarter? What are you going to do next quarter? And you can rob Peter to pay Paul and leave the cupboard barren. And it's one of the reasons we're one of the only publicly traded banks I know of that does not provide earnings guidance, because I am not smart enough to be able to predict what next quarter's earnings are going to be, because I don't know what interest rates are going to be, and I don't know what credit costs are going to be. So why try to pretend I do? Because it's human nature. If I go out and I say, hey, Todd, next quarter I'm going to make 85 cents. I'm going to bust my tail. I'm going to do everything possible to do that, which may include robbing from earnings in the future to make that happen.
So Brent, by taking those low cost loans, even though it's costing you money to have those on the short term, do you think that we will see interest rates hovering in that 5% for longer periods of time? I mean, what do you? And I know you have no crystal ball, but you talk about it. I mean, you must sit in the boardroom talking to, your board members and strategizing. What's the next move? Is this a sustainable thing? Should we plan on this? do you think we will see higher for longer?
That's what my bias is, higher for longer. But I've also been around long enough to understand cycles happen, right? And we've just been through a pretty steep tightening cycle, and typically you'll follow that up with a decline in rates. So, to John's point, right? Historically, we're still at very low interest rates, but I do believe cycles will happen, and I think you'll likely see mortgage rates come down in the future. What's important to us from a banking perspective is the slope of the yield curve, to have a positive slope on the yield curve. And we're now 18 months with a negative and an inversion of the yield curve. So getting back to a positive slope yield curve is what is traditional and is what's good for banks. But I do think that we will likely see long-term rates come down a little bit.
You want to put any time predictions on that?
No, I'm not smart enough.
The answer is no.
All right.
We have a super chat here. Who does high stocks and high home prices benefit? People who already have money. The average family with an income of 60 to 70,000 annually ain't making it. They can't buy a home.
Yeah, the chat is absolutely right, and I don't have an answer for that. That is the unfortunate reality where we are at today.
Yeah.
We do have some
Thanks,
other
Charles.
questions here. Thank you, Charles. That I
I
would
think he has
like
a follow-up.
as a follow. Oh, yep. Thank you, Todd. They are financing groceries. I know because I have friends that I've helped because I'm single, making $100,000 a year. The reason people don't care about the past for the economy because we live it now.
That's fair. I mean, so anybody who's struggling, I mean, like that's a real struggle, kind of to Brent's point earlier. But we're talking about kind of the general state of the economy, and this is still an economy. There will always be times when people excel and some people don't excel. That will always be the case. You know what I mean? And now is a period, and the last few years have been a period of it's actually been a very good period for the consumer. I mean, it's probably the best period for the consumer in the history of the United States of America. I mean, like all the money that flooded in, all the liquidity that flooded into the system. We saw what happened to used car prices. We saw what happened with house prices. We saw with the inflation. I mean, like inflation is a product of a healthy consumer. It's not the antithesis of that. So, I mean, as really struggles are, and we all have to kind of make our way through them. Kind of the overarching consumer is relatively healthy.
But the reality is inflation is a tax on the lowest earners, right? That impacts the lowest earners the worst. And that's the unfortunate reality of where we're at.
During the pandemic period, over 1 million homeowners had to have forbearance to stay in their home. Over 1 million. That's a big number. And that is after 6 months of not paying their mortgage. And we had the CARES Act that was put into place. And out of that, we have the American Rescue Act, which was implemented after mortgage moratoriums ended in July of 2021. They put the CARES Act where the American Rescue Act, where they distributed money to the states to give borrowers, in some cases in Maryland, it was up to $50,000 per household. It was a 5-question, qualification process. Do you own your home as your primary residence? Are you late in your mortgage or housing related costs? So I think with all due respect, John, I think a lot of people would argue the fact that this hasn't been the best time over the last couple of years. But I hear you. I mean,
but best time. But what I would ask them, best relative to what?
To the prior 5 years, maybe the prior 3 years when we weren't paying $12 for a dozen of eggs.
You can't have. we are in a system that has cycles. Like, it's a natural law. This is not me choosing we have systems. It's not Chairman Powell choosing we have system. It's not Bernanke. It's not the FDIC. This is human nature. You know what I mean? And we talked about this yesterday. I mean, cycles have propelled the United States to the position that we're in. So it's like, yes, like we have to be sympathetic to those who are not in the same position as we are. We have to. That's the kind of a duty of humans. But like, this is the system we have. We can operate within this system, or we can make excuses and not operate within the system. Like, you know what I mean? Like, this is just a system.
Yeah, I hear you.
And this is what we got.
It's a system.
You know what I mean? It's what we got,
It's a broken
you know?
system. We've seen about, and I could be wrong on these numbers, but we saw about 23% wage growth since about I think 2000, the last 23 years, and we've seen almost 190% home price increase. I mean, it's to Brent's point. I mean, that's not, as Brent said, you're not just giving a raise and all of a sudden you can afford a roof over your head.
But Todd, that data, that is not a fair comparison, because the interest rates, there's an inverse correlation between interest rates and asset prices, as you know better than anybody here, because you've been on the other side of that. You know what I mean? And so like, you can't just look at the increase in home prices and just use that as a statistic. You have to look at what the consumer is actually paying for these things. You know what I mean? So it's like, and I don't know what that statistic would be. I think I'd like to look at it.
40% more today than they were, at least on a conservative side, than they were in 2019.
But here's the antithesis of that. We're not in a Great Depression right now. And you know where we should be? We should be in a Great Depression right now. Because GDP fell in the second quarter of 2020 on an annualized basis by 30%. We've never seen that before in history. I mean, the fact that we are not right in the middle of a Great Depression, everybody should just be thanking the lucky stars.
And you don't think that has anything to do with the federal government propping up mortgages?
It has everything to do with the federal government. The
So
reason that we're not in the Great Depression. It has everything to do with it.
right. I guess that's the question. All right, what else we got?
Okay. What are your thoughts regarding solutions to the unsecured debt bubble? Is debt settlement going to cause catastrophic losses for lenders?
This is going to Brent. Brent, do you guys do credit cards?
We do. So we do very, very few credit cards. So it's less than half of 1% of our portfolio. As I said, we try to focus on secured. Unsecured, I don't think it'll be catastrophic, but clearly that's where I think the pain will be felt in terms of banks that have large unsecured portfolios. But it is amazing. And it's one of the things that we haven't talked about, that the banking system has failed the consumers, in my mind, because as you get increased regulation, banks are forced to focus on the best borrowers. And by the nature of that, we're leaving everybody else out. And what's happening to everybody else? They're having to go to the payday lenders. They're having to go to, the hard money lenders. And as a result, they're ending up paying 20 and 30% interest rates. How do you ever dig yourself out if you're paying a 20 or 30% interest rate, right? At WaFd, our average loan portfolio, I think we're about 5.5%, right? If you have debt leverage that's 5.5%, that's a whole lot easier than paying something that's 3 and 4 times as much. So it's one of the things I think we should do as a banking industry, is say, how can we welcome back those that are unbanked or underbanked, that are going elsewhere and being charged these usurious rates?
Brent, to John's point, and to what I was talking about, the Fed bailing out. So we know that we would be in a catastrophic position if Silicon Valley Bank and the like wasn't bailed out. I mean, we'd be looking.
But let me clarify. Silicon Valley wasn't bailed out. They failed.
Yeah.
The shareholders went to zero. The management team, their holdings went to zero. So they were not bailed out. The depositors at Silicon Valley were bailed out, which I think is the right thing to do, because had the depositors taken a loss, I mean, if the regulators look under the covers and give them a clean bill of health, how in the world could we expect the depositors to know anything different?
Great point. Thanks for correcting me
That's
on that,
a really good
because
point,
yes,
actually.
the investors definitely. So when we look at the depositors were saved.
Yes.
Let's take it from a real estate perspective, because if I look at banks and I go to your, analogy, we've got 2 sets of banking institutions. We have the too big to fail, then we have your bank where it's purely on you at the top to make sure that no matter what happens, and you said it, no crystal ball, no matter what happens, and you have a great track record, you have to make sure that you pull through this for your shareholders, your depositors, your employees. When we look at the real estate industry, I see like that same two-tier system. We have the commercial real estate industry. We have the residential real estate industry. The residential industry, I would say ranks up there with the banks that are too big to fail, because the catastrophe that would happen if we let these million homeowners all of a sudden be put out on the street and foreclosed on. But yet we're dealing with this unsecured debt. I look at the commercial real estate as you're the bank that gave them the money. It's going to be your baby. You know, maybe there'll be a program for you, but you might have to figure out how you're going to deal with that asset. You might own a building that you don't really want, right? Yeah. And figure out how you're going to get out of it. Like the story that we were talking about, where you were fortunate to have a borrower with integrity to pay you back. You're going to deal with that, and the bank's going to be like, hey, that's your baby. But with these federally insured loans, you know, Fannie Mae, Freddie Mac, FHA, VA. Now we've got the other side of that. So we'll isolate the residential to where I say is the industry that's too big to fail as far as the regulators go, considering they're writing or insuring the bulk of these loans. What about the unsecured debt? So $1 trillion in credit card debt, whatever the real number is for auto loans that are up for repossession because they don't have enough repo people to collect these cars. And what are they going to do with them all? Put them in parking lots? Who's going to buy them? At least they're letting people go back and forth to work. If they take their car, they can't get to work, right? Home equity lines of credit, you know, borrowers doing things in speculation that now they're looking at higher rates. Will the government come in your opinion, and erase some of this consumer debt?
Well, I think there's two questions. Will they or should they? I think we're seeing that they will, what they're doing with student debt now. Should they, I think, is debatable. I do not think they should, because I think there should be consequences. If you take out debt, you need to pay back that debt. And if you can't pay that back, you shouldn't be taking that out, which is really easy for me, as one of the questioners says, sitting here in my suit, to say you shouldn't be taking out debt when people are having to take out debt to put groceries on the table. I understand that, but we have to live within our means. That is a tenet of our society. It's a tenet of our system. Our government is not leading by example. We're living far beyond our means as a country, and eventually there will be a reckoning to that. When that is, I don't know. But I don't believe that the government should come in and say, hey, Todd, we're going to forgive your debt, but John and Brent, you need to pay yours. I mean, you've got all kinds of, fairness issues, equality issues. And then if we're going to forgive that, who's paying it?
Yeah. So, but you think that is quite possible?
Well, I think we're seeing it today. So I think it would be naive to say it's not possible.
So what form would that come in? Would that be, because here's what I look at. Okay. If I have a credit card that has a $5,000 credit limit and I'm charging that up, I'm paying 30% interest on my unpaid balance, and every month it's becoming more and more and more. So the government, would they come in and say, okay, Todd, I'm going to give you $4,000 to pay off that credit card. Now I've got a $4,000 in credit limit. Or is it the people that go bankrupt at that point that says, hey, we'll bail out the bank of the realized loss at that point, so you don't have to take that as a realized loss? What form would that come in? Would the banks, get the money directly, and the consumer would have to take that as a bankruptcy?
Yeah, that's really hard to know. It's pure speculation as to what may happen. So I don't want to go there, but we are so far from that at this point, right? The credit card charge-offs have not been substantial. It certainly looks like with the debt, as you've called out, exceeding $1 trillion and what's happening with rates, that charge-offs will come. But that's a natural part of the cycle. You would expect that. That's part of why they're charging 25% interest, because they're setting aside those reserves and they have the capital. So first, let the stresses fall where they should on the borrowers themselves. Then if the borrowers can't make the payments, they're going to declare bankruptcy. There's a system for that. The charge-offs will hit the banks. They have the buffer. So we are so far from saying, what would the government have to do to bail out the banks themselves?
Gotcha. Makes sense. Yeah, I mean, with them paying the high interest rates, that's the penalty of carrying the debt,
Correct.
the unsecured debt.
That's
It's
right.
not. I mean, it's a risky
And they're being
proposition
paid for it.
from the banks. Yeah, I got it. Melissa?
Thank you. This super chat is directed to John. Ask him to name a cycle when we printed $7 trillion in 3 years. Also, when was the last time the Fed pulled off QE without a rug pull? They never have pulled off QE in 7 QT cycles.
John?
Okay, so your question is when in the past has there ever been $7 trillion $7 trillion worth of liquidity flood into the United States financial system? The answer to that question is never before. But a couple of things to keep in mind. One of which is that you have $7 trillion today is not $7 trillion 200 years ago. So you have inflation, but we have seen these periods. Okay, so this is actually a really important thing. If you want to understand the history of the United States banking industry, in fact, if you want to understand the entirety of the United States financial system and its history, what you have to understand is it is dominated by just a handful of large flows of money that flow into the system. And there's two ways that money can flow into the system. It can come into the system from another system, like Europe, or it can kind of come up through the ground like a geyser, like from the Federal Reserve for money creation. And so if you go back to the beginning of the country, we had a big surge of these right after the revolution. We had a big surge right around the Civil War. We had a big surge in the 1870s. We had a big surge in the 1970s. And then finally, after a long period of time, since 1973 until about 2020, anybody who's in the banking industry who's kind of like trying to get a gauge of where we are at right now, there's a big question like, are we in the last era? Are we in a new era? Are we in some sort of purgatory? And the reality is that when that money came in from the coronavirus crisis and flooded in the market, the $7 trillion, which to your point, to the questioner, like this, that's a really good point. We've never seen that come in before. And what is the consequence of that when all that money comes in? Here's the consequence of that. So you have in any economy, you have an equilibrium, a variety of equilibriums, but one of the kind of fundamental equilibriums that you have is the equilibrium between the amount of liquidity in the system, i.e. money, and the goods and services that are in the system. And anytime the system is never truly in equilibrium, it'll kind of like pass through equilibrium like a broke clock, is right twice a day, but it's just kind of passing tangentially through it. So the system is either moving out of equilibrium or moving back into equilibrium. And when the system is jacked out of equilibrium, so when you put a whole bunch of money in and your goods and services stay the same, what happens is you get way out of equilibrium. So the system is going to naturally want to come back into equilibrium. And how do you get that system back into equilibrium? Well, ostensibly, like the easiest way is right, just increase the amount of goods and services in the economy. Well, that's a great thing, but the problem is you're working on a fixed production schedule on those, so you can't increase those on a short-term basis. So what you see the system doing is it goes through these what I like to term liquidity destruction events. And so that's just like where you're destroying liquidity and just in step moves, moving that thing back towards equilibrium. And there are two types of liquidity destruction events that are particularly effective. The first type is a bank failure. Your bank fails, you're just destroying liquidity just straight out. The second type that is particularly effective is a stock market crash. And so you go back through time and you start thinking about like how these crises have unfolded. There's oftentimes, now this most recent one is somewhat dissimilar because there's a COVID crisis, but typically you'll see a kind of a stock market crash followed by a kind of an economic downturn in the midst of which banks fail. And all that is, one way to think about all that is that's just the system trying to move it back into equilibrium and just doing it through liquidity destruction. And so the $7 trillion coming in, that is incredibly significant because what that means is we have started a new era in banking. and the system is way out of equilibrium. And we've already seen a couple of liquidity destruction events. And it's my belief, kind of based upon my kind of reading of history, that pile of money that came into the system in 2020 and 2021 is the thing that will dictate the banking and in fact, the financial industry's course over the next 50 years.
All right.
Thank you. Okay, we do have some more questions here I would like to address really quick. Is the U.S. economy strong enough to support Ukraine financially, while at the same time fighting a war in the Middle East and possibly China defending Taiwan?
I'll let you take that one.
I feel like I'm on a presidential debate.
That's good.
Yeah, I probably should stick to what I'm reasonably good at, I hope, which is banking. But clearly, we have our own struggles here internally in the United States, and trying to fund these multiple wars is a challenge at best, especially considering the house of cards we're in from a debt perspective. So that is a legitimate question, and I don't pretend to have the answer.
Yeah, I'd say. I mean, one of the things we talked about earlier was the debt not being sustainable. I mean, Powell in that he was just on an interview, 60-minute interview, and I loved it, by the way. I thought it was a great interview. He said a couple key things. One was, there wasn't any guarantees that these rate cuts were going to be happening at any particular time period. I mean, because I think the markets were expecting it in January, then they were expecting it in March, and we may not see it in March. But he also said that we were on a path of unsustainability in debt. And to the point, I just want to talk about something for a minute, because we talk a lot about, we've mentioned this a couple of times, about confidence. And a lot is predicated on confidence. I've always said, through the years of being in business, which is since 1989, I've been self-employed. I've seen some big ups and downs, but I always said that recession, and maybe this would be redefined here in the next year or two, but I always said that there was no such thing as a recession, that it was all based on hysteria. And it was pretty much pushed out by mainstream media. And we talked about banks and how they can lose their reputation for a bad rumor. And all of a sudden, people just pull their money out of their liquidity. John, you were talking about that. And boom, now they're in trouble because of a bad rumor.
Yeah, perception becomes reality.
Right. So it's self-fulfilling prophecy. But when we look at the media through the years has been controlled in such a fashion that we could simply talk people into a recession. And what do you do by doing that? You talk about bad things coming or bad bank failures, talk about things. All of a sudden, people hold back their money. They don't spend any money. Of course, we enter into a recessionary period. And then all of a sudden, the media comes out and says, hey, it's over. Everything is great. And these are the good stats. And boom, we start spending money again. But the same thing is with the confidence of the dollar. And we talk about, can we afford this war? Can we, fire up the money printing machines? But what happens is, and this all comes down, in my opinion, to the confidence that the dollar in your pocket can buy you the same thing as it did yesterday. When it can't, and the little follow-up onto your point is, all of a sudden you have money in your pocket and you know that you have enough to go into a restaurant and buy a meal, and you can pay the restaurant, walk out full. Well, what happens when that dollar drops to the point where you could no longer have the confidence to go in and feed yourself? And we see that. I mean, remember, a call was a quarter in a call booth, a phone booth. I don't mean anything other than what I'm saying here is that I think a lot of this, what we're talking about, is confidence based on where things are headed. But when we look at the wars that are going on right now, we look at the rate of inflation that's going on right now, we look at the bank failures that are in the news that we're hearing right now. We see home affordability being where it is right now and people struggling, giving up. I think people are just losing confidence.
And that goes as well to real estate, right? Who's going to make a house purchase unless you're confident that you're going to keep a job, right? I mean, confidence is so important. But back to my point that don't always look in the rearview mirror, right? What we're experiencing now, we may not be able to see directly what the path forward is, But my experience has been you keep your head down, you work hard. And even if we go through a terrible time like the Great Recession, even if you go right, think about real estate. How many people left the real estate field going through the Great Recession only to miss out on the upside coming out the other side?
And it all depends on the variables you choose. Things can be as good or as bad as you want them to be, depending on the variables that you choose. You look at life expectancy, which is a kind of an important metric. Like life expectancy is pretty good. You know what I mean? Like it's better than it was 50 years ago. It's better. It's a lot better than it was 100 years ago before penicillin was. Or I guess penicillin was invented a little before that. But like, I mean, it all depends on the metrics you use. And so, like, yeah, I could go out and fix the metrics and make it seem like everything has been worse. Is worse now than it's ever been. I can go out and find metrics that say it's better than it's ever been. So it's like, and kind of to your point about the media, it isn't just the mainstream media that talks about this. It's all media. I used to work for a company that, I won't name the company, but one of the things that we did was we tried to get a lot of clicks on articles, okay? And one of the things you find is that a negative headline will get like 6 to 8 times the clicks that a positive headline will get. And like, there's a lot of reasons for that you can dig into behaviorally, but it's like everybody in the media, that includes me, that includes you, that includes the mainstream media, non-mainstream media, we're all responsible for this. We all talk about the negative stuff a lot more. We talk about positive stuff because it gets a lot more clicks. You know what I mean? We all own that.
Well, we want to report what's actually happening.
100%.
And that doesn't happen a lot of times in mainstream media.
And I agree with you.
Right.
And I 100% agree with you.
And I think that's, look, I think you have to call it as you see it. And our industry, I mean, look, we can talk about, and I'll say it again. I mean, bankers, I don't think bankers have a bad reputation compared to a real estate agent or an attorney or something like that. I mean, we have a pretty bad reputation that I have to deal with every single day. And, saying, hey, we're not all like that. Not all of us put our commission check in front of our clients' needs. In fact, that would be terrible to do. Right. But I do think that it is part of my responsibility to clarify what's really happening on the boots on the ground, because the information that we are getting, guys, I'm telling you right now, what you may be hearing in your business may not be what's really happening in the boots on the ground. And you need to, you probably do that. Part of your success is finding out what is happening on the boots on the ground, going into these businesses. You do it going in and following up with your client and seeing, geez, what's really going on here. But I think we just, I think we just need to prepare people better. I think it's just the industry, our industry, my industry, just needs to do a better job of preparing people.
But to the point, and I think it kind of come full circle, perspective, right? Understand what's happening, but understand holistically, not just, right? We get so narrow-minded. And one of the learnings I've had going through what I've gone through over the last year is we get so focused sometimes on the negative, sometimes on our differences. Oh my goodness. Well, yeah. we're both religious, but hey, let's focus on the differences of our religion, right? And the differences are real and we should celebrate those differences. But we have totally forgotten about what we have in common, the humanity we share. And let's focus just as much on what we have in common as we do on our differences. And that's really changed my life. I don't really care what people believe. I care, do they believe, right? We all get up and we participate. We all draw the breath. We're here having the human experience together. And let's focus on the commonalities we have just as much as we focus on the differences.
Yeah, that goes for the aisles. I mean, there was a time where people on each side of the aisle could be friends and knew that there were people involved in the and that your differences are okay.
Yes,
you need that, right? I mean,
and they should be celebrated.
You want to be listening to one person and exclude what anybody else says. But Brent, that's a good point. Yeah, that's a good point. Melissa, as we're winding down here, what else?
We have some more super chats I'd like to get to really quickly before the end of the show.
These guys are great, by the way. I love a little bit of I wouldn't even call it a debate, but just that, look, guys, you have these real concerns out there, and there's valid points in everything you're hearing tonight. And I mean, John spent decades, researching, and he's a scholar in the banking industry. And I mean, we've had some really good times.
Well, and Todd and I were friends at this point.
Yeah, that's
like
right.
we can
That's
say
right.
anything. You know what I mean?
We've
we spent all
really
day yesterday together.
we
It was
did
awesome,
we did.
by the way.
And Brent, and I thank both of you. Brent, thanks. I mean, for having us in your office. I mean, it's just such a pleasure and an honor, really, and to to share this time together. I very much appreciate it.
No, the honor is ours, and no, I think we need more debates like this. Let's not just get together and all sing kumbaya, and we all think. Let's talk about where we think things are different and why, and allow space for us being wrong.
100%. I agree. All right, let's take those final questions.
Okay, cool. So if owed money should be paid, what about the $236 billion under TARP?
That's yours.
I'm happy to take that. And TARP, like it or not, TARP, the banks pay back TARP. Where the TARP did not get paid back was in the auto industry. So I'm happy to say the banks paid back TARP. TARP was a net gain for the government doing what they did with banks. So you can argue all you want. Should have TARP have happened, right? The banks needed to be stabilized, and that's a path they took. And I'm grateful for it in hindsight, but it was a good thing for the government because the banks paid it back.
Got one here talking about the specific area of Des Moines, Iowa. Search the area of Des Moines, limit the search to $250,000 for the max price. Over 50% is pending. This is happening in almost every market right now for below median price points in January.
Yeah, I mean, certainly as you look at the homes that there's such a minimum amount of inventory, what I would consider to be affordable housing. I mean, 250,000 or less, would be, certainly in that category, and it's absorbed very fast. And to Brent's point, you have a whole side of it, the investor side of real estate, where I mean, they can buy that house and turn around and rent it for positive cash flow. And so, and that's what Brent's saying too. And so the question is, and that's another podcast all in itself, the debate on whether the government should step in. It's anti-capitalism, to say, hey, these investors, I get both sides of it, shouldn't be able to buy up all these houses. They shouldn't own 40,000 homes, 30,000 homes. But this is the sweet spot where these investors are going to be all over it. So if we see a certain reduction in home prices, there's a lot of money in the marketplace right now. When we look at fractional ownership, these new platforms that are coming out, and all the cash that's on the sidelines right now by these big funds, they are ready. They are waiting on the sidelines for these prices to drop, because they know that there's, especially when you're talking about single family homes, there is such a finite amount of this inventory, and people like them. They want to live. They don't want to live. Not everybody wants to live in an apartment or a condominium, which is essentially the same thing, just different, you're renting or owning. But yeah, that's true. I'm surprised it's not more than 50%, honestly.
Mm-hmm. How about this one question? Is it true that large banks are using the backstop created in the wake of SVB? They are parking money from the Fed or Treasury, forgive my ignorance, and making money at that window?
Yeah, so that has to do with the term funding facility that the Fed put into place. And want to clarify a couple of things. Banks pay market rates for that money. The one caveat that they gave banks to help stabilize things was you were allowed to borrow based on the face value of the bonds you pledged, not at the fair value. And that was very helpful for institutions that had bonds that were significantly underwater. That being said, I think the time has come to pull that back, which is exactly what they're doing. And yes, banks, including ours, took advantage of that because they saw an opportunity. And you have a fiduciary responsibility where you have an opportunity to utilize that.
Brent, would the opposite of that be the discount window? Would that be the opposite of that, where you're actually collateralizing those bonds at the discounted rate? I mean, is that what?
So the discount window, historically, it's been tainted, right? You don't want to go there because you're troubled, but that taint is going away. That perception is going away. It's just borrowing from the Fed. And traditionally, the securities you pledge at the discount window, they get discounted compared to their face value.
Oh, wow.
So the discount window is more conservative than this term funding facility they put in place that was temporary.
You think that'll pick up once they end this term funding program?
I don't think so. I think in all likelihood it will be Federal Home Loan Bank borrowings. There's all kinds of sources for banks to fund from.
So, and just a final round here, if we can, where I see David popped up there. Melissa, do you want to take David's question? Super chat. We try and make sure we the super chats.
Word salad. I've lost even more banking confidence. David does have a couple more that I'm just gonna throw up here. Bear with me one second because he had a few here. Keynesian, modern, momentary theory, nonsense. Will they agree to a debate with Peter Schiff?
No, because I got other things to do.
And then we had another
That's
one.
your final
here.
answer?
That's my final answer. I hate to say it like that, but no, he'd win. Okay.
All right.
Deflation is good. In 1920, we were on the gold standard. Correlation is not causation. We had that one come up. And then we had Charles here. Let's not pretend here the reason Silicon Bank got saved by the Fed is because Governor Newsom and big tech had money in there above FDIC.
Again, a correction. Silicon Valley did not get saved.
It failed completely.
It failed completely. The shareholders lost. The depositors there were saved, and there were a lot of people that had money in Silicon Valley. But to me, it was important to do that to keep confidence in the system. Because should depositors really have to understand the financial performance and safety of their banks when even the regulators that are getting real-time information weren't able to adequately judge that?
All right. So we'll do our final round here. Brent, we'll start with you. What are we going to see in the next 12 to 24 months as far as recession, no recession?
Sure. I would say over the short term, I think a recession is unlikely. I think the economy is surprisingly strong from my perspective. I know your next question is what's going to happen with rates. And as I said, I don't have a crystal ball, but I believe that the Fed funds future market is overly aggressive. I think the Fed will likely pause and stay on pause for longer. It could be until June, and then maybe towards the second half of the year, you might see 1, 2, maybe 3 reductions. But I think higher for longer is likely our reality. And could the Fed start cutting? Absolutely, they could, but I think it will be less than forecasted.
And then the final, just a follow up to that, Jay Powell. I think we established that the Fed, we have the two scenarios, the too big to fail, and then the smaller banks that are basically on their own, not with the depositors that they'll probably be saved, but as far as bailouts and things like that. You think Jay Powell's done a nice job?
All things, I think he has done a nice job. I think if I were Jay Powell, I walk back their transparency. I think they have made a mistake in trying to project where they think interest rates are going to go, because oftentimes you'll hear them say, we're going to be data dependent, but here's where we think. those two are contradictory because depending on what the future data is, and so they end up boxing themselves into a corner trying to predict where rates are going. So I believe they've been too transparent. I think it would just be better to say, hey, you know what, our mandate is simple: low inflation and full employment, and we're going to act accordingly.
All right. Okay, John,
What do you got?
let's talk about bank failures.
Yeah.
What's your opinion? Are we going to see more bank failures here? Or, and I'm going to preface this with, we talked about this yesterday.
Yeah.
You were on a couple podcasts shortly after Silicon Valley Bank.
Yeah.
Right. And you said the banking,
No more failures.
no more failures.
Crisis is over.
Right. Crisis is over. And then we've had about 5 more at least, right? Or thereabouts.
Yeah. I mean, everything we've had since then has been relatively minor. But we talked about this yesterday. Why would I come out and say, somebody who studies failures, somebody who studies crises, and we talked about this, like there have been 9 major crises in the history of the United States. 8 of them have had a double bump in terms of failures. It is only reasonable to expect a double bump in this time in terms of failures. So we had the first bump, we had, Silicon Valley, Silvergate, although Silvergate is voluntarily liquidating, but it's basically the same thing as a failure. We have Signature, we have First Republic. That was your first spike. I would anticipate another spike, but the question is, you can anticipate another spike, you can anticipate other failures, but that doesn't mean anything because there's going to be. It's an issue of timing. It's all about the issue of timing. Like we'll have between now and 20 years from now, we'll have hundreds of banks that fail. That's just how the system works. You have 17,000 failures since the beginning of the country. That's just how our system works. So there will be more failures. When are they going to be? Hard to say. I think if you are in tune with what's going on in the banking industry and you kind of know the players and kind of know how their balance sheets are structured, I think you can look out there and get a pretty good sense in terms of the names of. I'm not going to name them. In terms of the names of who would be in trouble. But again, like I'm not going to name the names. And again, like the point, like we made yesterday on the podcast, is that like if you are in the media and people look to you as some level of authority in banking, and I don't claim to be any type of like huge authority, but like there are some people who read my stuff and every now and then my condolences to all of you. But you can't be somebody like me. You can't be somebody like Brent. You can't be somebody like Chairman Powell and come out and say that you're expecting more failures, because they can become a self-fulfilling prophecy in an industry that's based upon confidence, and where you can have that spread of risk just go out across the industry. You just have to be careful with what you say. So maybe you're being a little bit dishonest, but you're not being dishonest because you're trying to lie and just mislead people. You're being dishonest because you're trying to be a responsible steward of the industry. And if you're a responsible steward of the industry, you're a responsible American citizen.
You say that there's about 4,500 banks in America,
Give or take, yeah.
and you said that other countries, the most is 400.
That's ranked second. That's Russia.
All right, so Russia, 400 banks. United States of America, 4,500 banks. Should we see consolidation in the banking industry? And, this 4,500 number, do you think that's something that will, you think that's the most that we'll see for quite some time and that will shrink?
I would be surprised if we don't see for many, many years to come the number of banks decreasing every single year. We have been an overbanked, and there's historical reasons for this, but we have been an overbanked society for a long time. And we're trying to let me actually draw a finer point to this. Okay. So the number of banks in this country went from about a couple thousand in the early 1870s up to 31,000 in 1921. Why was there that enormous surge? Is because there's a birth of disposable income. And that happened here in America. It was the first time anybody had extra money just sitting around to spend. And that money was sitting where? In savings accounts, banks. So all this money is flowing into these savings accounts. And you have all these banks growing up, starting, because what do banks do? Banks arbitrage money. So you have this enormous growth in the number of banks, that then comes off that. Then we've been kind of coming off of that ever since. So if you think about the chart of the entire history of banking, just that whole chart, we are on basically a big bubble that's been coming down since the birth of disposable income ever since 1921. So the question is there's a lot of people, you go to these conferences and like these clowns get on stage and they try to like guesstimate how many banks there's going to be in the future, which is just totally ridiculous. I mean, you should just shut your ears as soon as you hear people starting to talk about that, because nobody has any clue. And it's just like you just throw a dart at a dartboard with a blindfold on. But here's the thing. If you actually care about this issue, about where the consolidation in banking is going, what you have to realize is why is banking consolidating, and what are the forces that could either throttle or in some way govern that rate. And so you look at you look across the country today, you look at the kind of the allocation of banks where they're at in the United States, and what you find is that the states with all the banks, by and large speaking, are in the Mississippi Delta and the Ohio River Delta. And why are they? And we talked about this yesterday. Why are they in the Ohio River Delta and the Mississippi Delta? They're in the Ohio River and the Mississippi Delta because the topsoil there is a foot deep. When you have topsoil that's a foot deep, you have all these little farms that stay in these families because it's so valuable. They want to keep that, and the yield on that is so high. So all these families keep these little parcels of property. And when you go and you lend on these parcels of property, you got to know the farmer. Does he drink and drive? Does he have good kids who are going to take over? Does he take care of his equipment? Does he know how to irrigate? Are there depressions on his property? So like it's actually going to hurt the yield on what he's getting off of that. Does he actually know what he's doing? Does he know how to irrigate? Like you have to know all these things. And like technology is one of the things that banking, kind of like, the introduction, not the introduction of technology, which is ridiculous because technology has been part of banking ever since, but kind of the evolution of technology right now is kind of one of the big stories in banking, but it has not cracked the nut on that. And it's going to be a while. And so what you're going to see in consolidation in banking is that consolidation in banking is a function of consolidation in agriculture. If the big agriculture, if those big companies coming down that are moving down, consolidating in agriculture, can suck up all those little farms and put them all into their own thing, well, then they're spreading the risk themselves. They don't need banks to spread that risk. So it is my theory that if you want to get a sense for where that's going, you have to look at what's going on in agriculture.
All right. Well, we thank you both very much. All right, Melissa.
Yes, thank you both so much. Thank you for hosting, accommodating, and fitting Todd into his traveling schedule this week. We're so fortunate to be able to connect with both of you, and looking forward to the great content that's coming that you guys have been recording. And yeah, it's been a great show.
Well, it's only 7:00 here, guys, so we get to go out and have some dinner. So those on the East Coast, good night.
You get to do fun things.
Thank you very much.
Thank you, guys.
Todd. You're the best.
We appreciate you. See you all next week.
See.